The spot chart looks calm. That's the dangerous part. You open your app. Gold is down 0.5%. Silver is flat. Nothing dramatic. No panic headlines. No breaking news banners. Everything looks normal. But the real risk isn't on the spot chart. It's underneath it, buried in layers of derivatives most investors never look at, and most commentators never explain. Because the real instability in gold and silver today isn't about the metal. It's about the contracts built on top of the metal. And those contracts are growing faster than the physical foundation beneath them. That's the time bomb. Not visible, not obvious, but structurally embedded. Let me show you what most people miss. When you look at a gold or silver price chart, you're looking at a reference price. That price is heavily influenced by futures trading, primarily on major exchanges where contracts change hands every second. A futures contract is not a bar of metal, it's a promise, a leveraged promise. And leverage changes everything. With one contract, a trader controls exposure to thousands of ounces without owning a single ounce physically. They post margin, a fraction of the value, and the rest is effectively borrowed exposure. That works beautifully when markets are calm, but it becomes explosive when volatility rises. Now here's where the time bomb begins forming. Over time, speculative positioning builds. Hedge funds pile into long exposure during bullish momentum. Commercial traders hedge aggressively. Options positions accumulate. Structured products are layered on top. You end up with not just metal being traded, but a web of obligations. Each obligation linked to another. Each one sensitive to price movement, each one leveraged. Now imagine a large directional move. It doesn't matter whether it's up or down. If volatility spikes enough, margin requirements rise. That forces participants to post more collateral immediately. If they can't, their positions are liquidated. And that liquidation doesn't ask whether gold is fundamentally strong or whether silver has industrial demand. It sells automatically. Now multiply that across thousands of participants. That's when spot price moves violently. But the real stress isn't the move itself, it's the chain reaction underneath. Because derivatives are interconnected. Futures link to options. Options link to volatility hedging strategies. ETFs hold futures exposure. Structured notes reference both. Banks hedge exposure through swaps. One stress point spreads quickly. That's the time bomb. You won't see it by staring at a daily candlestick. You'll only see it by understanding structure. Here's something else important. In gold and silver markets, the ratio of paper claims to physical supply can be extremely high. That's not automatically fraudulent. It's how modern commodity markets operate. Contracts are rolled, most positions settle financially, not physically. But during stress events, the dynamic shifts. If even a small percentage of participants demand physical delivery instead of cash settlement, pressure builds, because the system assumes most people won't. It's built on that assumption. Now let's be clear. This isn't about predicting collapse tomorrow. It's about recognizing fragility. When derivative exposure expands faster than underlying liquidity, the system becomes sensitive, like dry forest waiting for a spark. The spark can be anything: a sudden spike in real yields, a liquidity crunch in bond markets, a geopolitical shock, a margin hike, a large fund blowing up. The trigger doesn't matter as much as the structure. If positioning is crowded and leverage is high, volatility accelerates. And when volatility accelerates in derivative-heavy markets, price moves overshoot fundamentals. That's when you see gold drop 3% in a day with no major news. That's when silver collapses 10% in hours, not because value disappeared, because leverage unwound. Now think about the broader environment. Interest rates are elevated. Funding costs are higher than they've been in years. Cross-asset volatility is creeping upward. Liquidity in many markets is thinner than headlines suggest. In that environment, derivative exposure becomes more dangerous because funding stress spreads. If a major fund faces losses in one asset class, they may liquidate profitable positions elsewhere to cover margin. Gold and silver, being liquid, become collateral damage. You can't see that risk on the spot chart. You only see the result after it detonates. And here's something even more important. Central banks have been accumulating gold aggressively in recent years. That supports long-term demand narratives. But central banks do not operate through leveraged futures contracts the way hedge funds do. They buy physical, which means short-term price can disconnect from long-term accumulation. Because short-term price is dominated by derivative flow. That disconnect creates psychological confusion. Retail investors look at spot and think demand must be collapsing. Meanwhile, physical flows remain stable. The derivative layer is what's unstable. Now let's talk about volatility compression. Sometimes before major moves, volatility shrinks. Markets get quiet, price trades in a tight range, options premiums decline, participants get comfortable. That's when derivative positioning quietly builds. Because calm markets encourage leverage. Low volatility invites risk-taking, but when volatility eventually returns, the unwind is faster than anyone expects. That's the time bomb you don't see, the calm before expansion. And here's the paradox. The bigger the derivative market becomes relative to physical trade, the more price can be influenced by positioning rather than fundamentals. Which means you can have days where spot price looks disconnected from industrial demand, mining supply, or central bank buying. Because it is. It's reacting to derivative stress. Now let's address the fear angle honestly. Is there a risk of complete systemic breakdown? Extreme scenarios are always possible, but they are rare. The more realistic danger is repeated violent swings, price spikes, price collapses, margin calls, short squeezes, flash crashes, not necessarily collapse, but instability. And instability transfers wealth, from over-leveraged participants to disciplined ones, from emotional traders to patient allocators. The derivative time bomb doesn't explode once and end the story. It pulses. Each volatility event releases pressure, then leverage rebuilds, then another pulse. That's the modern commodity cycle. Now ask yourself something important. Are you exposed through leverage or are you positioned through ownership? Because there's a difference. If your exposure relies on margin, volatility is your enemy. If your exposure is unleveraged and strategic, volatility becomes noise. The spot chart doesn't show you derivative risk. It shows you the outcome after it has already begun unfolding. So what should you watch? Watch open interest trends. Watch changes in margin requirements. Watch volatility indices tied to metals. Watch real yields. Watch funding stress in broader markets. Those are early indicators of structural strain. And here's the final uncomfortable truth. The derivative layer isn't inherently evil. It provides liquidity, it allows hedging, it enables price discovery, but when it grows too large relative to underlying liquidity and funding capacity, it becomes unstable, like stacking too many floors on a foundation not built to support them. Eventually, stress reveals weakness. You won't see cracks on the surface at first. Then one day, a single shock exposes everything, and the spot chart reacts violently. By the time most investors realize what happened, the move is already complete. That's why understanding structure matters more than predicting direction. Because the direction isn't the risk, the speed is, and derivative-heavy markets move fast. The gold and silver derivative time bomb isn't a prediction of collapse tomorrow. It's a warning about structural sensitivity, about leverage layered on leverage, about calm markets masking hidden fragility. The spot chart may look stable today, but stability in derivative-dominated markets is often temporary, and when the next volatility wave hits, it won't announce itself politely. It will erupt. The only question is whether you're positioned to survive it or amplified by it. Let me know in the comments. Do you think derivatives stabilize gold and silver markets or make them more fragile? And if you want deeper breakdowns on how these hidden layers actually function, subscribe, because the most important risks in financial markets are usually the ones you can't see on the chart. See you in the next one.